Stocks. They are like, well, a lot of things actually. Relationships, gardens, pizza, football matches, cups of tea, and even pub quizzes. Confused? Not to worry, I'm here to connect the dots. Let's break it down. Stocks are like a relationship. Sometimes it's sizzling hot, and sometimes it's freezing, it's cold. And sometimes you're lying awake at night wondering why you got into it in the first place. But if you stick with it through the ups and downs, it can be incredibly rewarding. Just like a good partner, a good stock will grow with you over time. But unlike a relationship, you can't break up with the stock over text. You have to sell it. And that's a whole other drama. Welcome. Today we're diving into the world of stocks. Buckle up. It's going to be a wild ride through 400 years of financial shenanigans. In the 1600s, the Dutch East India Company was facing a dilemma. It needed money to fund risky trading expeditions, but did not want to take out massive loans. So, they came up with a novel idea, selling shares of ownership in the company. Investors who bought these shares got a portion of the profits, and the world's first stock market was born. Picture a group of Dutch traders excitedly waving slips of paper that granted them a share of nutmeg profits. It was like the 17th century version of investing in a tech startup, but with more wooden shoes and fewer smartphones. Before stocks, there was the tulip mania. You heard it right, tulip, as in the flower. A period in the Netherlands where people went absolutely bonkers over tulip bulbs. Prices skyrocketed with some bulbs selling for the price of a house. But when the hype faded, prices crashed, leaving many investors broke. The lesson? Investing based on hype is a risky game. Pro tip: don't invest in flowers unless you're opening a florist shop. Moving on to 18th century Britain, the South Sea Company was all the rage in the early 700s. It was granted a monopoly to trade with South America, and everyone, from aristocrats to your average Joe, went mad for its shares. People were so excited that they drove the stock price to ridiculous levels, even though the company wasn't actually making any money. Eventually, the bubble burst and the stock price crashed. Many people lost their life savings, including Sir Isaac Newton, who famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." The South Sea bubble is a reminder that stocks can be risky, especially when everyone's caught up in the hype. If something looks too good to be true, it probably is. Let's fast forward to 2021, and history repeated itself. This time with video game retailer GameStop. A group of retail investors on Reddit's Wall Street Bets sent GameStop stock price skyrocketing in a coordinated buying frenzy. The stock, which had been struggling, surged over 1,500% in just a few weeks. Why? Because everyday investors wanted to challenge Wall Street hedge funds that were betting against GameStop. Some made a fortune, others lost money when the hype faded. But the GameStop saga showed that retail investors now have the power to move markets. Lesson learned? Hype can drive stock prices, but fundamentals matter in the long run. Let's break it down with something we all love: coffee. Imagine if your favorite coffee shop wanted to expand. Instead of a bank loan, they decide to sell stocks. You buy one, and boom, you're a part owner. If they become the next Starbucks, you're golden. If not, well, at least you tried supporting local business, right? Next, stocks are like a garden. You plant seeds, that's your investments. Water them, that's your patience. And hope they grow. Some plants thrive, and others, well, let's just say not every stock is a winner. Sometimes you get a beautiful money tree, and sometimes you get a cactus that pricks your wallet. The key? Diverse your garden. Don't put all your seeds in one pot. Talking about diversification, let's go global. In China, there's a company called NIO. Think of it as the Tesla of the East. In India, Reliance Industries went from oil to dominating the digital economy. Moving on to Canada, e-commerce is booming, and Shopify has helped millions of businesses establish online stores. With the rise of digital shopping worldwide, Shopify has become one of the biggest tech success stories across the US. You can diversify globally. Buying stocks in these companies is like owning a piece of the future, but in different flavors. But why should you care? Well, as the legendary Warren Buffett said, buy into a company because you want to own it, not because you want the stock to go up. It's not just about making money. It's about being part of something bigger. Let's talk strategy. Meet Audrey, our investing superhero. She's not rich, but she invests $100 a month in a mix of stocks. Fast forward 40 years and Audrey is sipping mocktails on a beach, all thanks to the magic of compound growth and patience. But wait, before you sell your cat to buy stocks, remember what Bertrand Michael said. The most important thing about investing is time in the market, not timing the market. In other words, slow and steady. Slow and steady wins the race. Stocks are like a football match. Sometimes you're winning, sometimes you're losing. And sometimes you're just hoping for a draw. The market can be unpredictable, just like your favorite team. But if you stick with your investments through the ups and downs, it can be rewarding. And hey, even if your portfolio takes a hit, at least you didn't lose to your rival team. Silver linings, people. So there you have it. Stocks are like relationships, gardens, and football matches. They are complicated, unpredictable, and sometimes downright confusing. But with a little patience, research, and humor, you can navigate the market like a pro. As Bertrand, author of A Random Walk Down Wall Street, says, a blindfolded monkey throwing dirt at a newspaper's financial pages could select a portfolio that will do just as well as one carefully selected by experts. So don't worry, if you feel like a novice, even the pros sometimes just guess. That's all for today, future Warren Buffetts. Like, subscribe, and remember, in the world of stocks, knowledge is power, but patience is your superpower. See you in the next video, where we'll tackle ETFs, index funds.